The performance of the strategy over the 6 months to 30 June has been led most prominently by two sectors. The airports, where we've seen the recovery in passenger volumes post the global pandemic continue to exceed expectations. And that's been most prominent for the airports that serve tourist destinations. We've also seen strong growth from, or strong performance from, our regulated utility investments, particularly our electric utilities, with returns most pronounced amongst those electric utilities that are beneficially exposed to the re-emerging load growth in the US, driven by the deployment of data centers and the reindustrialization of the US economy.
Yeah, it's an interesting question because as we think about the holdings, and as we discussed, the holdings in the strategy are really centered around a couple of key jurisdictions. So we have obviously a lot of investments in North America, Europe, UK, Australia, New Zealand. And what we're finding in those regions is that inflation continues to abate and it continues to decline. And in addition to that, what we're seeing is a large number of central banks are starting to come out and either reduce interest rates or indicate an intention, a signal their intention to reduce rates. Now, when we think about our view, interest rates from our perspective are probably, if anything, at the peak, and they're, if anything, likely to decline or go sideways from here. So not overly counter consensus, but I think the general view is probably reasonable. Now, if you step back for a second, you think about the impact of interest rates on infrastructure, what you generally find is that when you have periods of rising interest rates, generally infrastructure in the short term, the share prices come down off the back of that. One of the things that we've certainly observed over the life of running this strategy, since 2009, we've seen a couple of events where rates have gone up. So this one goes back a way now, but you think about 2013, the taper tantrum. You think about 2016 when Trump came in and the resultant interest rate increase that happened off the back of that. What we saw is that infrastructure declined in those situations, typically by high single digits pretty quickly. Now, what we have experienced in the last few years, since 2022, is inflation has been up a lot compared to history. And we've seen, as a result, central banks increase interest rates rapidly to try to respond to that. And so what that has meant is, since about 2022, we've had a consistent headwind against the share price performance of infrastructure companies. And so as we think about how it looks going forward, if we expect interest rates, if anything, at a peak or declining from here, if interest rates are at a peak and they go sideways, I think infrastructure is well positioned to go back to delivering a CPI plus 5 type outcome. However, in a situation where interest rates actually are beginning to go down, that will likely benefit infrastructure companies. And we would expect in that environment, potentially you could outperform that expectation due to that environment.
The polls suggest that the race for the Congress in the US is neck and neck. And so there's a meaningful probability that we'll see a divided White House and Congress. And under that scenario, we'd expect a perpetuation of the status quo, with any legislative initiatives really the byproduct of horse trading and therefore unlikely to be particularly ambitious in their scope. There is, though, still a meaningful probability that we could see a Trump Republican trifecta. And in that scenario, some pundits have expressed caution that perhaps the Republican White House could roll back aspects of the Inflation Reduction Act implemented by the Biden administration. We think that's exceedingly unlikely. When you look at where the benefits of the IRA subsidies and incentives flow, they flow overwhelmingly to Republican states. So we don't think those incentives will be rolled back. Some pundits have also expressed caution that Trump might impose tariffs on imports of clean technologies, particularly from China, and that this would slow the deployment of capital by electric utilities. Again, we think this is unlikely. We continued to see the deployment of renewable energy technologies at a meaningful pace in the former Trump White House. And what's more, since that time, we've had a meaningful scaling of the indigenous manufacturing capability of these technologies in the United States. On the positive side, in the case of transport infrastructure, the Trump campaign has expressed more enthusiasm for privatization of transport infrastructure assets, roads and airports, and also for public-private partnerships. So this might be a tailwind to the capital deployment of some of the toll roads and airport operators in the strategy. across the strategy, we see profound and enduring secular tailwinds supporting the underlying financial results of the companies we invest in. These are perhaps most prominent amongst our electric utilities, who have a long runway of growth, likely to last at least a generation, supported by the energy transition as these companies invest to replace their legacy thermal generation with renewable assets, as they augment their distribution and transmission networks to connect new renewables, and to support the electrification of buildings, transportation and industry. And more recently, as we've seen the re-emergence of load growth supported by rapidly growing demand for data centres and the reindustrialisation of the US economy. So particularly robust outlook and growth expectations there. But those drivers are really replicated across the strategy. Amongst our water utilities, we see profound growth driven by increasingly stringent environmental requirements and the need to secure supply resilience. In our toll roads, they're leveraged to the increased economic activity and growth in their catchment areas and benefit from inflation-linked revenue growth. For our airport companies, we see continued growth at a multiple of global GDP, supported by the increasing affluence of the middle class in the emerging world, for instance. And finally, for our communication assets, where we expect significant growth in demand for mobile data, Ericsson puts it at perhaps 20% per annum over the period to 2029, to continue to require mobile network operators to hang more equipment, to deploy more towers, to increase the quality of their service that they provide to their customers. And of course, all of that lends itself to the tower companies growing adjusted funds from operations and earnings in a manner that's very accretive to shareholder returns.
投資信託なら東京海上アセットマネジメント。